JSW Steel is placing a bet worth thousands of crores. If they pull it off, they could dominate the Indian steel industry for the next decade. But if they fail, this could go down as one of the biggest corporate blunders in recent memory. This isn't just another business deal. It's a high-stakes gamble that could make or break an industrial giant. So is JSW's mega deal with Japan's JFE a brilliant masterstroke or a catastrophic misstep? Let's break it down.
So what's actually happening? On one side, you have JSW Steel, an Indian powerhouse with a hunger for growth. On the other, JFE Steel, a Japanese titan famous for its cutting-edge technology. They've been partners for over 16 years, since 2009, but this new deal is something else entirely. Here's the core of it. JSW is moving its Bhushan Power and Steel facility in Odisha into a new joint venture. JFE Steel will then pour in a massive 15,750 crore rupees to grab a 50% stake. The deal involves a slump sale valued at 24,483 crore rupees, creating a powerful new entity right in the heart of India's booming steel market. On the surface, this looks like a win-win. JSW gets a huge injection of cash and world-class tech, while JFE secures a massive foothold in the fastest-growing steel market on the planet. Analysts are already calling the deal value accretive, which is finance speak for it's going to make shareholders very happy. But it's the structure of the deal that raises eyebrows. It's a 50-50 joint venture, an equal partnership. That means for every big decision, both companies have to see eye to eye. This isn't just an investment, it's a corporate marriage. And as we all know, marriages can get complicated, especially when they involve two gigantic companies from two very different cultures. This whole thing is a tightrope walk between ambition and execution. So is it a calculated masterstroke or a risky bet that could collapse under its own weight?
First, let's look at why this deal is being hailed as a strategic masterstroke. It all starts with one of the most beautiful words in business, deleveraging. Before this deal, JSW Steel was carrying a consolidated net debt of roughly 79,153 crore rupees as of September 2025. That's a mountain of financial obligation that can choke a company's ability to invest, expand, and survive downturns. This one transaction is set to slash JSW's consolidated net debt by an incredible 37,250 crore rupees. We are not talking about just chipping away at debt. This is like taking a giant chunk out of it. The move gives JSW massive financial flexibility and the breathing room to chase its growth plans without being chained to interest payments. Analysts estimate that JSW will receive around 32,000 crore rupees in cash, a war chest ready to fund future projects and solidify its place at the top. But the real genius here isn't just the money, it's the strategy. The joint venture is planning to more than double the BPSL plant's production capacity from its current 4.5 million tons per year to 10 million tons by 2030. And there's even potential to push it to 15 million tons after that. This expansion couldn't be timed better. While the global steel market looks a bit flat, steel demand in India is soaring, projected to grow by around 8 to 9% annually. India is the bright spot in the global steel industry, thanks to massive government infrastructure spending and a red-hot construction sector. This deal positions the new JV to grab a huge piece of that action. And that's where JFE's role becomes crucial. This isn't just about cash or capacity, it's about technology. JFE Steel is a world leader in making high-tech, value-added steel, the kind of specialized steel needed for modern cars and the advanced grain-oriented electrical steel, GOES, that's vital for power transformers and India's green energy shift. This isn't the basic commodity steel that's always in a price war. This is high-margin premium stuff. By mixing JSW's operational muscle in India with JFE's tech brain, the JV can create products that competitors will find tough to match. Their long-standing 16-year partnership builds in a layer of trust which helps lower the risks that usually come with new collaborations. So, when you look at it this way, the deal seems perfect. JSW cleans up its books, unlocks huge growth in a booming market and gets its hands on elite technology, all while splitting the bill with a partner it already trusts. It's a strategic home run.
Now let's flip the coin. For every argument that this is a masterstroke, there's a counter-argument that it's a multi-billion-dollar gamble. The biggest risks aren't on a spreadsheet, they're in the boardroom and on the factory floor. The first major red flag is that 50-50 governance structure. In theory, an equal partnership is fair. In reality, it can be a recipe for total gridlock. JFE's business model even prefers these insider-type ventures where both sides must agree on everything. This means neither JSW nor JFE can make a move on their own. What happens when they can't agree on a major investment or a strategic change? A partnership that needs constant consensus can grind decision-making to a halt, which is a death sentence in the fast-paced Indian market. This risk is magnified by the huge cultural and operational gaps between the two companies. Japanese corporate culture is famous for its careful, long-term planning and consensus building, the Nemawashi process. This could easily clash with the typical Indian approach of fast top-down decisions and agile execution. Think measure twice, cut once versus move fast and break things. While both styles work, mashing them together in a 50-50 venture could cause a lot of friction. There's a real danger, even noted in JFE's own documents, that decisions from a distant Tokyo head office won't fit the local reality in Odisha. Trying to manage a 25,000-person workforce and blend these two opposite management styles is a massive headache waiting to happen. The second huge risk is just pure execution. Doubling the plant's capacity to 10 million tons by 2030 is incredibly ambitious. This isn't a simple upgrade, it's a colossal industrial project needing flawless management, billions in capital, and thousands of new skilled workers. Any delays or cost overruns would put a huge strain on the JV. On top of that, the JV itself is expected to take about 21,000 crore rupees in new debt to fund this expansion. If the steel market takes a nosedive or interest rates shoot up, paying off that debt while managing this huge project could become a nightmare. Finally, while the Indian steel market is a bright spot, the global picture is shaky. Steel prices have been soft, and the threat of Chinese exports still hangs over the market. Even with strong domestic demand in India, the JV isn't immune to global price swings. If the expected rebound in steel prices never happens, the rosy financial projections making this deal look so good could fall apart fast. So, the bear case is pretty clear. A complex management structure that could lead to paralysis, a total reliance on pulling off a massive and costly expansion flawlessly, and exposure to a volatile global market. This is no sure thing. So what's the final call? Is the JSW JFE deal a masterstroke or a risky bet? The truth, as it usually is with these things, is somewhere in the middle. This is not a reckless gamble, but it's a long way from a guaranteed win. The best way to describe it is as a calculated and audacious masterstroke, but one whose success depends entirely on dodging a minefield of operational risks. The financial logic is rock solid. Wiping 37,250 crore rupees of debt off the books is a game changer for JSW Steel, giving it a stronger balance sheet and the cash to fund its next growth spurt. Partnering with a tech leader like JFE to ride India's steel boom, which is expected to grow around 9% a year, is just smart strategy. India is where the growth is, and this deal puts both companies right in the middle of it. But the masterstroke part comes with a big if. It all hinges on execution. The biggest hurdle will be making the two corporate cultures work together in a 50-50 setup. Success will require more than shared financial targets. It will need a genuine commitment to building a single unified way of operating. Management has to set up crystal clear rules to prevent decision-making traffic jams and ensure that Japanese precision can successfully merge with Indian agility. Ultimately, the success of this venture boils down to three key questions. First, can the leadership of JSW and JFE create a smooth management system that works across cultures? Second, can they pull off the massive capacity expansion from 4.5 to 10 million tons on time and on budget? And third, will India's steel market keep growing strongly enough to absorb all that new capacity? The deal is a bet on India's future. It's a bold, forward-thinking move that could set JSW up for market leadership for years to come. The potential payoff, market domination, technological superiority, and financial strength is huge. But the risks are just as big. It's a masterstroke in concept, but its legacy will be written in its execution.
Now, I want to hear from you. When you weigh the massive financial upside against the very real risks of integration, what's your take? Is this deal a stroke of genius that will redefine Indian steel or a disaster waiting to happen? Drop your verdict in the comments below. And if you enjoy deep dives like this, do me a favor and hit that like button and subscribe for more business breakdowns.
The JSW JFE joint venture is one of the most fascinating corporate chess moves we've seen in India. It solves JSW's urgent debt problem while paving a path for incredible growth. It's a potent mix of financial smarts and strategic guts. The road ahead is tough, filled with complex integration challenges and huge execution demands. But if they can pull it off, this multi-crore bet won't just be a masterstroke, it will be the foundation of a steel empire for the next generation.